Futures are down Friday after the close, making headlines, obviously. Traders are going to brace for Sunday night. We have to go over this story. It's a big one. I think what's happening beneath the surface is super important because there are some positive developments, and we need to talk about what smart money is already doing. Super important day. We had a lot of major moves after 4 o'clock. Volatility is definitely going to be back on the table. If you're not watching these levels, you're going to have an issue. Let's get to it. 27.5% of you do not subscribe to the channel yet. Watch for the past 30 days. Subscribe, click all notifications. What we go over here is extremely timely, and these videos come out at different times. Let's get to it. Now, we have a lot to go over, and a short time to do it. So what I want to do is go through the basics. We can obviously see the big drop. We all know why it happened. We're going to get into it in 30 seconds here, but you want to make sure that this itchy FOMC speech level, that holds, the October 2024 PPI level holds, and that is going to be that 59.35 level. We don't want to lose that Sunday night. Watch Sunday night's open. The other level that I would watch is down here, and what I will do here is I will just blow this up for us so that we can see it super big, and that's the July CPI when we had that negative price point. The PCE data is that level, and the December contract roll is also that level. And when I just go back, you can see how far these levels are going to go. We'll drop it like it's hot to a 4-hour. And yeah, I'm going to talk a little fast in this one because there's a lot going on and you're probably going to want to listen to points of this again. I would be super, super careful about buying the first dip unless they come out and miraculously change things based upon what happened. But that's not what I'm seeing. And what I did see was this, and I think I should share this before we go any further. You watch gold rally substantially on the news and just absolutely start breaking out. I would expect that to continue. The other thing that will happen is the trade is usually sell equities, buy gold, sell bonds. And that's what's happening. And it's usually the long end because that's the dragon's tail. The other one is TMF. So they are the 4 big areas, not to mention the dollar and crypto, but they are the 4 big areas that will get hit. The easiest, most direct is equities, the dollar, the bond market, and go from there. And it is usually sell equities, sell bonds, the dollar usually drops, and they usually buy gold. Let's get into the news. Now, Friday after the close, we have news, and that news spread to a couple different outlets, obviously, because it was very big. And I think it's super important to just view how the world is looking at this. BBC comes out that evening and says the U.S. has lost its last perfect credit rating as influential Moody's expressed concerns over the government's ability to pay back its debt. In lowering the U.S. rating from AAA to AA1, Moody's noted that successive U.S. administrations had failed to reverse ballooning deficit and interest costs. A AAA rating signifies a country's highest possible credit rating and indicates that considering it to be in a very good financial health, strong to pay its debts. Moody warned in 2023 that the risk was there. Fitch Ratings downgraded in 2023, and S&P Global did so in 2011. Moody's held this until 1917. So it's been over 100 years since this happened, and they have thrown in the towel. One of the key reasons for this is the Congressional Budget Office projects that the federal debt held by the public will rise from 100% of GDP to 118% in 2035, which would exceed the previous high of 106. 106 in 1946 was when we came out of World War II, to put that into perspective. Despite the debt downgrade, Moody changed its outlook on the U.S. from negative to stable. The reason that they're doing negative to stable is because you literally just dropped one rating. So you're dropping that rating down, and at that rating, you're saying you're stable at that rating. If you understand how Moody's works, you would understand that it's not like they upgraded the stabilization of the U.S. They stabilized it at that particular spot. The credit agency said it retains exceptional credit strength, such as the size, resilience, and dynamism of the economy, continue to roll in the U.S. dollar, global reserve currency. The country is on track for very effective monetary policy led by an independent Federal Reserve. Interesting statement there. But this is when you get into somewhat of a debt crisis. And whether or not we're actually in one or not in one remains to be seen. But it expects federal deficits to grow from 6.4% in 24 to 9% by 35. That's not great. Increased interest payments, rising entitlement spending, and relatively low revenue generation. A couple things here that people really need to wrap their noodle around. Number one, the U.S. is paying over $1 trillion now in debt. It's absolutely just an interest payment. It's absolutely crazy. when you think that our single greatest expense now is debt payment. Rising entitlement spending, and I think that this is where it's going with Humana. Just going to say that the Humanas of the world, the UNH, I have a very different view on what's happening there, and I'll get into some of that in today's video. But this relatively low revenue generation, this is why we're probably seeing the tariffs. But we've been talking about this for some time. Cheaper goods, cheaper goods. Even Treasury Secretary, cheaper goods, and the American dream is not like cheap Tupperware. So I do agree with this. Obama's economists warned that the Biden administration and congressional Democrats against reckless wasting trillions on COVID stimulus bills that piled up our nation's defense, fueled runaway inflation, and forced the Fed to raise interest rates for everyday Americans. You're going to have a lot of people that are going to say, this isn't us, this is them. My take on this is, and I think it's important to understand where we're going with this. The Fed injected $1.3 trillion in the market as, here you go, guys, go have fun. JPEGs were called NFTs, and we were told we didn't understand them. There was a lot of froth that was in this market, and that has yet to come out. That Inflation Reduction Act was absolutely insane. So you do have the past administration that has fed this. That said, this has been going on for some time. So it's not something that just happened a couple of years ago. And this is something where you're going to have to see major changes. Everybody agrees to that. The fact that it happened Friday at 4 o'clock, from a trading perspective, when we start talking tactically about these charts in a couple moments, it's not great. But I do think it's going to present opportunity, and I'll show you where I think that's going to happen. But this whole thing of the Trump administration Republicans focused on fixing Biden's mess, is it really just his mess? No, it's been going on for some time. We're going to spend more money, It just doesn't work this way. But did the previous administration exacerbate the problem? Yes. Did COVID exacerbate the problem? Yes. They're just facts. Everybody agrees to those facts. If you take a look at this one big, beautiful bill in our House back in order, there's delusion, and there's delusion on both sides. One bill is not going to fix this. You actually have to cut spending. And the question is, where's that spending going to be cut? And I think that that's becoming clearer with what's going on in one of the sectors, and we're going to talk about that. If Moody's had any credibility, they would not have stayed silent in the fiscal disaster of the past 4 years, says one of these Republicans. Great. Nobody cares when they came out with this. No one's saying they did this because of Trump. Maybe you'll get political people that'll say that. Who cares? The downgrade came as the House Budget Committee on Friday rejected Trump's domestic policy bill. One of the things that they do cite in this is the amount of disarray in Congress, their inability to get anything done. If the tax cut is extended, it would add $4 trillion to the primary deficit, including interest payments over the next decade. I get that. Is this the time? Is this a political motivation? I personally don't think it is. Some people are going to feel that it's a hit job on him. I'm not in that camp. I think these are the cards that were dealt, and now we have to play those cards. And I do think there's something here that's worth mentioning. Moody's first gave its pristine AAA rating in 1919, the last of the three major agencies to downgrade it. But before that, in 1917, they had that AA1 rating. So they raised it up, and this is actually the first time that they've actually lowered the rating, ever. And I think that that's really important for us to take hold of. And I think that's way more important than just understanding or thinking that they just did it just to do it. But this spread pretty far and fast all around the world, and that should be our concern with it. And I just want to take a second to review something that was said by Buffett in his last Berkshire meeting, because I think it's really important for people to get this. As we call once again for the end of the world, in the 20th century alone, and this is a quote from Buffett, we dealt with two great wars, one of which initially appeared to be losing, a dozen or so panics or recessions, virulent inflation that led to a 21.5% prime rate in 1980, the Great Depression of the 1930s, unemployment ranged between 15 and 25% for 25 years. America has no shortage of challenges without fail. We've overcome them. In the face of these obstacles and many others, the real standard of living for Americans improved nearly sevenfold during the 1900s, while the Dow Jones Industrial rose from 66 to 11,497. This too shall pass. Now, obviously, this video is a little packed, and I'm going to move around a lot because there's a lot to cover, and we actually had new developments, so I had to work that in, but I'm trying to compress this to get all these facts in because there's a lot going on here. I want to point to a signal that I think is super important. And what you have in front of us is a smart money, dumb money graph. And this obviously is going to be for this 5 years that we are currently in. which here is July 20, and then here we are in 25. And I think this is super, super important for us to get. First and foremost, what we're always looking for are patterns, because patterns are how we recognize what's going on, and past performance of patterns are the best way to determine future performance. That's all we have. It doesn't mean that it's going to work, but that's really all we have is past performance. So we go and look at that and say, okay, well, what happened during those times? For us, it's super easy, but to look at this and figure out where we should go, but to actually apply it, it's a little harder. I just want to point this out. We don't refer to this as smart. We don't refer to this as dumb. We refer to this as institutions. We refer to this as retail. Why? Because that's how smart money is calculated through institutional order flow. Dumb money is calculated through retail order flow. We also want to just point something out before we go any further with this. Smart money institutions takes its time. Retail moves like a cat on a hot tin roof, where it's, I'm in, I'm out, I'm in, I'm out. And institutions are like, we're going to take our time. And that can be seen very clearly here as institutions are just kind of like slowly buying. And retail's just like, I got to get out. The sky's falling. Everything's going down. I got to get back in. And meanwhile, institutional is just kind of chugging along. All right, super important concept to get as we're about to go through this, and you'll see why. So what we had happen was we just got a really very clear signal earlier this week where smart money and dumb money crossed. And when they cross, we want to pay attention to that. There's several signals here, but really when you see the smart money break after popping up, break that level right here, which is like a 0.7, you want to pay attention. At the same time, when you watch dumb money or retail cross down here, you want to pay attention. Why? Because smart money moves slowly, meaning they're going to sell very slowly. Where dumb money or retail, I got to get in now. And then they're going to push it all up. So if smart money is up here or institutions are out here and they are full with order flow up in this area, let's clean this off for a sec. If they are full up here in this area, maybe I can make that a little smaller, the dot. Then we really want to pay attention to that. So we'll have this little range up here. And you can see for the past 5 years, this is the fullest that they've been on saying, oh, we need to get involved in the market from a smart money institutional order flow perspective, right? You haven't really seen that since back here. And this is obviously very hard to play. Why? They were giving us $1.7 trillion. That's what Itchy and company were selling to us. So it's really hard to compare this to that. Always important to understand the macros of where you are, right? I mean, if the Fed is dumping trillions of dollars on you, it's kind of hard to expect the market to go up. It's not rocket science. So if we look at this area here, we have this little cross like right there and go, okay, well, that's good. And then we have this one here. The other signal that I like to use that I find very helpful is when you see smart money or retail sell. Then you see retail rushing into it. So when retail's rushing in, smart money's dumping. And for those that are just listening, because a lot of people just listen to this, you're really just watching for smart money to cross below that 0.7 line and dumb money to get above that 0.3 line. And for those that are actually watching, you can obviously see the graph on YouTube. So if you look at these areas right in here, as we pop over and then rally, this is exactly what you're looking for. And you have one here. And a lot of people will look at this stuff and say, well, you don't know. No, I don't know anything. All I can tell you is this just happened. And when this happens, this tends to mark bottoms, as it did here in 2023. It marked a bottom. You would take a look here at the end of 23 here in October, and you would say, oh, look, that marked a bottom. That's all I know. I know when this happens, and we can see this in the first quarter of 24, and say it with me, it marked a bottom. So when we see this, it doesn't matter the magnitude yet. The cross is what matters. And why does that cross matter so much? The cross matters so much because it's understanding that smart money is actually institutional and dumb money is actually retail. See, when you pull these things apart and you start understanding what they are, the devil's in the details. It always is. And you can see this throughout history. Now, if we just zoom in on that 3 hour before we go look at some other time periods where I think that this is, as someone likes to say, absolutely glaring. And just for reference, this is from Sediment Trader. This is not my graph. But I have talked to them before and they're fine with me using it. So you can see our cross right in here, and the wider that we have this kind of movement in here, the spread is what I'm looking for. That's the cat's pajamas, or as I like to say, the ant's pants. So I really want to pay attention to this area and those kinds of flips. When I see it, you can't unsee it. And it's the exact opposite of what happened here in May, June, July of 23, where you had an inverse where retail was fully loaded for bear, and then you have institutions that were saying, we're not buying. So when retail sells, as you can see here, what happens? Retail, they just dump. And then institutions like, just keep dumping. We'll just pick up the pieces of the ones we want. And then when does that flip happen? In 23, at the end of October, where she says, hey, we're not going to raise rates anymore. We're done fixing the problem that we created. And then we can just see here in October, November of 23, how you just absolutely unequivocally ripped. Now, do I think we have the potential to get something like that again? I think we do. We obviously have to deal with what just happened with Friday's information, and I do think there's going to be weakness on the market with that. But people are going to say, we're the only game in town. On the US side, that's not entirely accurate anymore. So especially if you go and look at Germany and the price points of Germany and what's going on there with the 10-year, but they will get it under control and it will lead to selling in the market, but they will fix it. They don't have a choice. So we have to understand that. But it's very important to understand where people are at. And if you're up a lot in your trades right now, you have to think they're going to get out. People will get out of those trades. But we know that we don't have an inverse relationship. So what do I mean by that? We know that when people are getting out of those trades, we know that retail's not going to dump. They're not even full yet. So retail doesn't really have the ability to dump on the market. Institutions have the ability to dump on the market, but they're not really in a hurry. They could be if something catastrophic happened. I'm not sure that what happened on Friday is going to be labeled catastrophic. I think it's going to lead to a rebalancing and some profit taking for a couple days, personally. But I don't think that it's going to lead to anything catastrophic. As always, these are my opinions. And as everyone's opinions, this is information education. That's how I look at it. And I've been wrong before, and I'll be wrong again. But I always appreciate your comments on this stuff, and I do respond to everybody. So keep the comments coming, and please keep subscribing, because the more you subscribe, the less I have to worry about putting ads. And I try not to put ads in the middle of any of this stuff. But the algorithm loves that stuff. So as long as you subscribe, share, and comment, it helps me out a lot in getting this message out. And people always ask why I do this. I do this so people can learn what it really takes to be successful at trading. It's not what people think. Obviously, there's a lot more that goes into it, except looking at a pretty chart and going here, buy here. There's a lot of moving parts to it. So if we look at these flips, and we're just looking at the 1 year from 24 to 25, are these areas of interest that you would want to have paid attention to? I think so. I think these are areas that you'd want to pay attention to. Now, if we go back through history, take a look at this. And as I like to say, but wait, there's more. Let's clean all that off. And you're going to have to deal with some of the roughness of this as I record them. I don't edit them. We just rock and roll and go from there. But we're going to mark this off, and you can see May 2012 right here. We have that flip where smart money is dropping and they are selling, and dumb money, they are buying, or retail. And we can see those flips over and over again. And I think they're super important. You can see here January 13. And what I'm doing is I'm just marking them off and when they happen, because they're giving you demarcation lines. Here you are again, right around October 2013. Here you are on the 14th. And what are these areas really doing? Well, they're telling you that after you bottomed in these areas that you've got it all clear. And they're not telling you, everything's fine. But what they are telling you is, hey, we're probably going higher, Boomer. That's really what they're telling you if you look at it. And I don't think that it's really rocket science as to why. If you have one group of people, and this is, again, devil's in the details. If you understand that smart money is institutions and smart money moves slow, and dumb money retail is like, I'm in, I'm out, I'm in, I'm out, then it makes sense that when smart money's selling and they're taking their slow time and retail's trying to get in as fast as humanly possible, that you can see it's a supply-demand issue. And that demand issue you can make money off of. That's pretty clean stuff. But there's some other examples here. And I find these examples helpful because then you could be, it wasn't just one period in time. But again, take a look at 04 right in here and this flip from there. And you don't even have to be over. I like when the dumb money is over and the retail is under. Like, they're the ones I really like, but I don't have to have that. I could just have the flip. And again, what this flip is showing you throughout the past 25 years as I'm doing this, for example, the ones that I really like a lot are when retail is at that level where you're at like a 0.3, and then institutions are at like a 0.8, and then they flip. That kind of stuff, that's the cat's pajamas. Why? Because it's going to take forever for institutions to dump, and it's going to take forever for retail to get involved. So I have all that power behind it, unlimited power. And so you can see this right in here, that from like December 2005, perfectly, you never looked back. But wait, there's more. September 2006, you never looked back. And that's super important for us to get. Now, I find looking at examples over time periods of different time periods and different monetary and fiscal policy super helpful. But I'm always interested in your comments. And so if you think there's too many examples here and I could have cut them out and used less examples, let me know. Now, here's an example of this happening, marking a high on May 8th, 2008. I apologize for those that are just listening. Some people listen to me on a treadmill. But if you're here and you see 2008, but there's some issues here, right? Like we have what we would refer to as a macro issue here, where the underlying stool that we're sitting on, if we're sitting on this stool, I don't know that I'm gonna be able to draw a stool that way. We're gonna have to get old school here. But if I have underlying macro issues, then the fundamental issues are going to change, and then the technical issues are going to be an issue. Depending upon where the stool slides, I could have problems if I lean back on technicals, right? See, I did that. So what's important about this is understanding this is one thing. It's not all the things. You just don't do the thing because it's one thing. But to look at this and dismiss it, I think you'd be remiss. But on May 8th, just because people were putting a gazebo in their backyard and then trying to mark their house up $200,000, that's probably going to be a problem. But once you come through the back end of that, I think this thing's excellent at marking bottoms. For example, this May 2009 bottom that was marked roughly around April 2009, this is perfect, absolutely perfect. And it shows very clearly what's going on here. And you can see for years, 2-3 years, you just had retail to stay completely invested until you had your other flip here in 2011 that kind of marked a short-term high on the market. But for years from that great financial crisis that you came out of, this marked it perfectly. And you can see right after that how the cycle just completes itself again, where we get full and then we have the cross to the downside of smart money, dumb money. But look what happens here on September 10th. We flip right back over again, and then we just rip. And then we get full here, but then when does that bottom come in? Because people are going to be buying that bottom September 2011, which is kind of interesting that fits perfectly with that bottom right here where you flipped last time. Isn't that kind of interesting how that happened 1 year later? But what happens right here, again, January 2012, you put a bottom in, and you never look back. Rallies up, you get your pullback, everyone says the sky's falling again, but wait, retail comes right in, May, June 2012, and the market just continues to rip. Is this the be all end all? No. Is this something you need to pay attention to? Oh yeah, you need to pay attention to this. And you need to think about it in the context of institutions move slow, retail moves fast. If you don't look at this and understand the time frames, I'm not looking at this saying, hey, by Tuesday, we're going to do X, Y, Z. No, what I'm saying is, hey, when this starts to happen, you can see movement for a 6-12 month period if you take a look at these time frames. Semiconductors to me represent what I consider probably one of the greatest opportunities out. You can have your opinion on it and you're entitled to it. I just don't think people truly understand what happened this week. So I'm going to spend some time on it. Matter of fact, if you watch the pre-market videos, the public ones, I was really clear on this with NVIDIA this week. Like I was shocked that this name didn't move at first. I don't think people got this, but that presents more opportunity for me. And maybe it's because I've seen these cycles for the past 26 years. So these comments and these charts you're about to see are from a gentleman called Edward Yardini. Where I want to go with this channel, and this is why I'm on the subscribe thing so much and on the comments and the sharing, is I want to start having guests on because there are experts. If the bigger the platform, the easier it's going to be to me to get these guests on. So that's why I'm all over it. I figured I'd start when we got to about 100,000 subscribers, but apparently it's taken a lot longer than I thought, but that's okay. It's pretty specific content, and I'm not going to change the content to broad base the content. I'm going to keep the content what it is. If I went broader and I don't know how else to say it, dumber, I would get more people, but I really like getting into the minutia because the devil to me is in the details, and you can't dumb this down. You're playing against the smartest, most disciplined people in the world. And the reason you're playing with them is because this is where all the money is. So to act like you don't need to do this level of detail or pay attention like this, I'm just doing people a disservice. I'm not going to do that. So that is why you're seeing the memes and the push to get subscriber growth up. So let's do it. Okay, the Trump administration has announced plans to rescind the Biden-era rule prohibited capped or sale of advanced semis outside the U.S. in an effort to keep tech out of countries of concern. Interesting term. The details are expected over the next few weeks, but before the ink is dry, new rules. Saudi Arabia ordered billions of dollars of semiconductor chips from NVIDIA and AMD and others during President Trump's trip to the kingdom this week. Also got a cool plane. Here's what's super important about this. Before we go any further, nobody in NVIDIA's numbers, in AMD's numbers, Saudi Arabia ordering billions of dollars in chips. So what does that do to their revenue guidance and their earnings guidance going forward? Forget if it's weaker somewhere else, but what does that do to it? Would that make their revenue guidance going up or down? If you had a country that was able to start buying product from you and they had what we would basically say unlimited funds, and they're revamping their entire existence, do you think that would be good or bad for those companies? I'm interested in your comments. More orders are expected as Trump continues Abu Dhabi, and we have a couple people in the room from Abu Dhabi. It's kind of interesting. I think there's about 2 or 3% of the communities actually from that area, and it seems to be growing as people migrate there. AMD signaled its optimism for future, announcing $6 billion buyback on Wednesday. They're not alone in buybacks. Where do you see these figures? It has also contributed to a furious rally that has lifted the S&P. Well, I mean, semis, yeah, they rallied, and I agree with what Yardini's saying, but they got smoked. I mean, it was like, people were going to go back to an abacus. So what's Yardini's point? Now, for those that want to read the full thing and to give this guy credit, if you type in his name, and you're going to see his name in some of these slides in a second, and type in his name and just type in LinkedIn, you'll find the full article. And you can go there and read all the comments and everything that he has to say. Just Yardini, LinkedIn, and you'll find it. The diffusion rule has been opposed by many technology companies, including Microsoft, Oracle, NVIDIA, which believes it could limit tech company opportunity. Well, duh. If one of the biggest countries in the world with unlimited funds doesn't buy your product. Thanks, Captain Obvious. But the move was expected to benefit chip makers, including NVIDIA, Intel, who are we kidding? AMD. I think this is absolutely huge for NVIDIA because they're the 800-pound gorilla. I was shocked that this thing was trading at 123 and didn't move. And I was pretty adamant about it in the community. They know I was like pounding the table on it. Everyone kept asking about what names they should look at. And I kept saying NVIDIA. But the point of it is, I'm buying the 800-pound gorilla. You should do what you're comfortable with. I do think that names like Microsoft, Oracle, they're going to benefit greatly. Because now they're able to go into that country and start setting up data centers. And here's the crazy thing that people aren't really understanding about this. And I'm going to chime in here and just go off script. When you're dealing with a monarchy versus a democracy, it's very easy to get things done. And people don't like that. They're like, democracy, yay. And I live in the US. What I'm saying is when you have to deal with one guy versus having to deal with all these other people, you want to get something done. It gets done. If he wants it done, if the monarch wants it done, that's a super important concept to get from a business perspective. So when Microsoft said this week that they want to go put AI data centers in Saudi Arabia, they need the approval essentially of one person. Not to get through Congress, not to get through the Senate, not to get through the local area where they need to pull power from. It's very clear that it's much easier to get things done in a monarchy than it is to get things done in a democracy if they want it done. If they don't want it done, then it's not getting done. Just understand that. And it's very clear that Saudi Arabia, UAE, this whole area wants this done. You can disagree with the structure of government, but you can't disagree with the fact that if somebody is a monarch and they want something done, it's much easier than going through a democracy. Chip order surge. NVIDIA announced on Tuesday a partnership that will help Saudi Arabia into a global powerhouse AI and enterprise digital twins robotics. The company is working with Humane, a subsidiary of the Saudi Public Investment Fund that was launched this week. So just so we're clear, there's a brand new fund that basically has unlimited funds that wants to turn Saudi Arabia into a global powerhouse in AI, cloud, enterprise computing, and robotics, which scare me a little bit. But before we go down the Skynet route, just think about this. Did anyone take Microsoft's numbers up or Oracle's numbers up or NVIDIA's numbers up? Anybody take their numbers up this week? Any investment banks? Just something to think about. In 2004, people that know me know I had like a huge setback. And one of the guys that helped me, I had a mentor in 2004, and he gave me this book. And it was, I'm a huge reader. When the corporations are buying their own stock back and retail is puking, you need to pay attention. There's 6 ways to look at this. I'll do it super quick. So what we do, let's clean this off. What you do is this. When insiders are buying, when they're truly buying, not when insiders are borrowing money from the company to buy, to paint the tape, it's called. But when corporations are out there buying on these dips, that is the number one thing that you want to look at when a corporation buys. When institution ownership increases, that's the second thing you want to look at. When retail starts buying, that's the third thing you look at. So it's always number one, corporate buybacks. What's important about what I'm showing you on the screen right now, for those that can see it, in February, ON Semiconductor announced a new $3 billion share repurchase program. In February, ON announced a $3 billion buyback. AMD's already got a $6 billion. ASM International started on April 29th, a $150 billion buyback program. KLA increased its share buyback program, just came out with earnings, by $5 billion. Broadcom announced a $10 billion. So what do we have going on here? And again, super important. And I'm going to get rid of some of these because I'm going to follow this out, and I want you guys to watch the other part of this that I'm about to explain. The other thing that you want to pay attention to is when you start seeing any real insider selling, that is usually way ahead. Any institutional selling, and then retail selling is the tail end of this. So what do we have here? You have a perfect storm, in my opinion, with semiconductors, because you have corporations going out there and saying these price points are ridiculous. And we bought AVGO. If you're in the community, you know this. We bought AVGO when they started buying their own stock back. Stock's up, I think, 60 points from there. And retail's puking them out. And the corporations are going out there buying. This is super important concept to get. All right, let's keep going. Really important to get this, guys, because once you understand this, your life gets very, very easy. They're putting their money where their mouth is. You have a new revenue stream, and no one's even talking about it yet. Now, he has some slides, and I like his slides a lot. There's his name right there. And so when he looks at S&P 500 semiconductors, he creates his own kind of sectors. A lot of us create our own sectors on the names that we think are important. So he has his own sector, so when you see this stuff, it might not coincide with yours. If you look here, you just see the 200-day moving average, and we broke below it, and now we're right above it. And I do think you have to look at the price and where you're at, and Blue Angel's implied price index. And what I like about this is he shows the recessions, but if he shows the implied price index by where he's at, like 25, 20, when you're over 25, that's kind of expensive, but you stayed up there forever, right? And you really never got above there. And so you had this expensive period. You came down and you worked it out to 20 on the way that he implies his price index. What's super important about this, the implied price index is calculated using forward earnings times forward PE. So what we really see here is where is that sweet spot? Well, the sweet spot really is if you can get down to that 15 kind of level. There's been times where we've gotten down to that 10 kind of level, like that's the sweet spot. You're at the top, the high end of this. So the question becomes, can you grow into this? And I think you can if you start looking at where they're going to start deriving revenue from in other areas. Now, he has the annual revenue growth forecast going flattish here and coming in going forward. And for me, looking at these on the consensus estimates on a percent on a weekly basis, this is percentage on a weekly basis. I don't really agree with how they're viewing this. I actually think it's going to ramp up, and I wanted to go through this. This is what I'm saying. I don't think people are out there looking at this as a new revenue stream. See, one of the things when I talk about these videos all being linked together and these talks all being linked together is that on the bottom, this is what expectations are. This is what outcome is. And then the differentiation between those two is where you make your money, whether that's on the short term or the long term, whether it's doing a 5-minute trade or doing a 2-year kind of trade. So if everybody thinks that you're going to go stagnant or drop on revenue growth and revenue growth ramps up, well, it's a completely different beast. And this one chart I thought was worth pointing this little nugget out. So you can go here and say, oh, well, S&P Semiconductor forward PE in this area, well, you broke 20. And if we just took that drop line from the 20 area and came straight across, you'll see 2005, 2006, 2007, 2008. In this area, well, that was pretty much the standard de facto area where semis traded on a PE basis. Even from 20 to 22, they were in that area. I think that's super important to get. Obviously, when the sky was falling in the great financial crisis, we had issues, the exact opposite issues you had during the pandemic. But coming off the great dot-com bubble, people don't really understand where these PEs were on names. Cisco was trading at 80 or 90 times forward earning. It was pretty insane. So semis back in the day were around, 40, 50 times earnings on average. Like, it was crazy. You're nowhere near that for those that are trying to make that comparison. Now, I think this graph does a really good job. And what you're going to see is the semis again, and this is how he's viewing those semi names and what he's looking at. And forward earnings here, and then forward PE. And I just think it's worth paying attention to. That while we're out here saying, oh, well, things are going to go down, things are worse than expected, wherever you are, the PE dropped, earnings are going higher, semis dropped. As earnings are climbing, we're not over. And we're actually cheaper now than we've been. Now, are you going to have volatility with this? Absolutely. But volatility is now our friend. It's not our enemy. We love volatility. Now, I want to tie this all together with what I'll be looking at this week and what I think is super important, what names I'm really focused on. I'm still focused on NVIDIA, and people will be like, geez, he's so obsessed. I just don't think what people are getting this. And even Monday, we saw this move where people are like, oh no, it's because of China. No, this move and the reason that you kept going is really very simple. It's because people are going to have to take their earnings up. They're not going to have a choice. Now, could we see some disruption because of what happened with the tariff debacle? There's really no other way to call it but a debacle. But Wednesday, May 28th, we have earnings on NVIDIA. And this, to me, could be really a game changer because of the PE and where NVIDIA is. You look at this and say that they're going to earn $4 and just call it $4 that they're going to earn. And if you look at that and go, okay, well, you're trading at 30, 35 times right now. People are like, well, that's ridiculous. That's an insane amount to trade at. But then you go here and look and say, okay, well, you were doing 39. I'm just going to pick 2 quarters. Here's 38 billion. And then you're going to go back to the other March quarter right here and realize that you were doing 22. So if we just did it simple, do back an envelope and say, I have 50% revenue growth year over year from 24 to 25. And I'm trading 30 times, 35 times earnings. 35 times earnings right now. When I look at the fundamental part of the stool, like when I look at that leg, my default mechanism is always revenue growth year over year. That's just my default. So if I'm over and I'm trading at 50, I'm fine with it. So if it's like, in other words, if I have 50% revenue growth and they're going to earn $4, if I was paying 200, I'd be like, okay, I get it. It's fully valued, but I understand it. That's how I use PEG or price earnings growth. That's just real quick how I would look at it. So when I see stuff like this, people are like, oh, it's too expensive. The average price. The average price of what, right? So it's understanding where you are. And it's so important to get this. You have sentiment that has completely killed this thing from $86. And this is where people tend to fail. This is why for those months when I say link these videos together so you watch them, in here we were doing what I refer to as a barbell strategy, which is super short-term trades, super long-term trades. And the reason I call it a barbell strategy is it looks like, to me, a barbell. And I'm not maybe because I go to the gym, whatever. But short-term, super long-term, meaning I'm doing everything and closing by the day, and then I'm scaling into a trade that I'm going to do over the next 3 months to a year. And I do this in non-trending markets. In trending markets, I don't do this. I go back and I start swing trading again, right? Different tools, different times. It's just the way that it is. You don't want to use the same tools the same times. Using moving averages down here is ridiculous because it's a lagging indicator. You need momentum. You need oscillators when you're in a non-trending market. You just do. You can comment on it, but so we have the top of this and we'd have to watch and make sure that we get this huge control bar done. Could we pull back because of what we're seeing right now in the market, because we just lost that last AAA rating? Yeah, you can. A lot of people are like, well, where are they going to go to get rates? I don't know. Germany looks pretty darn good right now, doesn't it? So if we put this in, and this is when I would start looking at this is a 3, a 5, and an 8. This is when I would start looking at moving averages again. This is your time to shine, moving averages. And looking at these lows, I'm probably not getting to that $110, but I bet you I can get down to here to like a 131. And knowing where these are is paramount. And what you would do also is watch your gap fills. I can't stress that enough this week, because if it continues, the gap fills are there, 100%. The other thing that you could do that you'll find super helpful this week, if I could give you any just really quick tip, is a volume profile from the low and just understanding where everybody is. A lot of people don't like these nodes and they view them as, like they're areas where they're going to run into resistance. They're bubbles. If these bubbles pop, pop goes the weasel goes pop, for those that like third base. So you want to be super careful of that in this kind of environment. But you can see, like, point of control is 114. Can you get down there before earnings? Can the market sell off that much? Weirder things have happened, man. I don't see it. I truly don't see it. I think institutions would just step like right in front of it with both fists going into earnings, knowing that they think kind of how I think. But these kinds of names, yeah, they could 100% come in, and I would use those kinds of metrics. The other one to me that makes a lot of sense on any kind of dip is going to be AVGO. I'm in this a lot cheaper, like at the 180s, but you have some gaps here. Now, are you going to fill these gaps to 186? At this point, I would just back up the truck. If it happens, I would back up the truck. You should do what you're comfortable with. And the reason I say that is because now I know that my revenue and earning streams are way stronger than people have in their estimates. They just are. And it's just fact. I mean, it just is. With what's happening with Saudi Arabia, people are they're just not getting it. I'm shocked that you didn't see upgrades this week on these names, that no institutional or investment banks trying to get ahead of this. But names like AVGO are super appealing to me in this kind of market. AMD is not overly appealing to me, and I know a lot of people love this name, but even when times were good, I don't have the revenue growth. So I don't really go near it. Like I get it. If I pulled this, we'll use this February or January 30th one. I get it, 6 billion, and then you go here, and now you're at 7.6. Like, I get it. I get the fact that like you are growing. But I'm not growing anywhere near what NVIDIA is growing. So why do I want to be bothered? I don't need to own 8 names in the same space. I'd rather own concentrated one name. I don't want death by diversification. People are like, oh, diversify, buy them all. How about I just buy the winner? That's kind of the way that I trade. You should do what you're comfortable with. But if we look at the stocks here and we go, all right, well, that doesn't look great. I could make an argument with the stocks that you actually left head, right shoulder, and this was extremely developed right shoulder, and then you drop your neckline down right around here, and you could say that we tested that neckline. And what I would do is I'd just measure from the head to the neck. And people would say, well, why is that the neckline? I like this as the neckline specifically because we retested it and failed. So that is a confirmation of a neckline that you've now broken above. So people would say, well, that's a head and shoulders. Well, the head and shoulders to me is negated because that's 24, 25%. And it's not an exact science. And you don't take points, you take percentages. You don't take points, you take percentages. So the way to measure a neckline once it breaks is take the percentage. People will take the points. It doesn't work that way, right? And you can figure out why 265 is a different number than 200. You don't need me for that. So here you are at 25%. So this head and shoulders pattern completed, and it held, and now it's lifting. Now, does it stay up, or do we sell off because of what just happened? I think you're going to have the possibility of coming down, but I don't see the debt news as a be-all, end-all. I see it as one thing that's going to create some selling that then we can take advantage of and actually buy. Another thing that's working very well in this market, and for short-term trades, but I'd like to do this on longer-term position building, and I'll show you in a second. I'm going to give you 2 examples. One that I did on a very short-term basis, but in front of you is UNH, and obviously they have a lot of issues. My sense of what's going on with UNH and Humana and these names is that I personally think the administration is going to go after them. And I think the administration is going to go after them because of entitlements and reform. And they're looking for a place to cut money. And if they went into it, and this is me with the tinfoil hat, I'll give you 2 seconds of it. If they go into it and say we have to cut entitlements because we can't afford the spending, it's one thing. If he goes into it and says they're stealing billions and we're going to get them and we're going to fix all this, everyone's going to cheer. So it's all for the presentation on how you take your medicine, one way or another. And I think that's where this is going. It's my opinion of this. Now, you had some news on Friday with this, and it's pretty clean stuff, but they're out there buying their stock in the open market. I want to just say something about this, and I'm going to show this chart, and I'm going to show the trade that we did. This type of stuff, from a short-term trading perspective, works great. Long-term, I've been around long enough to watch Enron and Tyco, where these guys went out and borrowed money to buy their own stock from the corporation. So when we see them buying in the open market, we don't know that they're writing a check. We don't know that they're not borrowing money from the corporation to write that check, to what we refer to as painting the tape. This is a super important concept that I could spend time on, but this is what happened to UNH. Now, I will trade this because it works. This RSI works. pretty well on stuff like this. And I'm going to just give you one really super advanced thing that I do that really hit very well here. And it actually presented an opportunity on this trade. I like RSI a lot. As I like to say, you don't have to believe in gravity, but gravity believes in you. I say it so much, they actually created this meme about me in the room. But I thought this was kind of funny. And he says he's my friend, but like every time he says he's my friend, I look at the faces that he makes on me. And take a look at this. And I just think it's worth pointing out because this is not something that people would do that's normal. First, he got rid of some. I have way more hair than that. Second of all, look how low that ear is right there. See how low that ear is? Look where this ear is. And he's been doing this to me with his little memes. He keeps making my ears bigger, and now he's making them crooked. So I don't know. Feel free to comment on that. But now back to the important stuff. So we can all see this divergence, this RSI divergence here. You guys are actually probably even upset that I pointed it out. But you see this divergence? Watch when this connects right there. Hold on. You'll see it, and I got to draw this perfectly. And I don't use the same levels that you guys use on the RSI. I use a 15 open, high, low, close because I want the full movement. I don't just want the close. And I understand why you do it, but that's there. And I'm going to drop this back down. And so we get the news that they're out there and they're going to buy stock. Right? They're buying stock in the open market. The directors, the CEO bought $25 million worth of stock. Maybe he used his own money. Maybe he didn't. We don't know that. Maybe they're exercising options to paint the tape. We don't know that. We'll find out through the Form 4s. But before we get into that, there's a move. And when that move happens, you want to take advantage of it. And you're seeing the turn start to happen in here. But for me, the big news was, oh, good, we're oversold again. We're back down. We're riding our trend line. Okay, this is all falling in line. Always super helpful to me when you have stuff like this, and I don't really use wicks on my trend lines, but you see how let me show you it this way. See how you broke right here? See how you're hitting and then you broke right there? There's another trend line here. I'm not going to get into it. Well, I guess I can since I just said there's another trend line here and then I'm not going to show it to you. It's kind of silly. I'll show it real quick because I don't want to spend an inordinate amount of time on it. But you have trend lines right here, right? You see how they're breaking? The idea of here, and this is kind of advanced, if you want me to do an advanced RSI class, just type in below and I'll do it. If there's enough interest, I'll do a video on it. But what you're doing here is, this is a leading indicator and it determines magnitude of the move. I don't care if you believe in it, gravity, etc. And it's not 100% right, but or accurate all the time. Of course it's not, or everybody would use it. But it is open to interpretation. When you're not breaking these trend lines and you're breaking these trend lines usually negate back and respect what's happening with the RSI. And that's a super important concept. So this presented an opportunity on that news, and then we were able to do this trade based upon it. And I don't want to own stock in this company because I don't know what the next shoe is to drop. And wherever there's a shoe, there's another shoe. I just feel that way. And I could be wrong and it can go to 350 without me. I'm fine with that. So once we saw this happen in the news, we just went out there, bought calls, traded those calls, made money on the calls, and then just blew them out and got out of the way. Super simple, easy trades. If you're not using RSI in this market and you're not using things like this, and I'll show you this as well, because these are the tools that I would be using this week. If you're using these gap fills like I just talked about, and now you go back to your trending market tools, see how you're stopping here? This is an 8, a 5, or 3, a 5, and an 8 on a daily. See how you hit that 5? See how you gap filled? See how you respected the 5? That's what you're looking for on any of these pullbacks this week. When you're going through all these names this week, whether it's Tesla or whichever names you're thinking of looking at, your default levels to me should be previous VWAPs or volume profile areas. But more importantly, you're going to want to watch any gap fill. Like here's a great one. Any gap fill that would get you down to like 335. People say that can't happen. It can happen in 5 minutes, man. In this kind of market, after everyone just has all these profits, it can happen. And so you would say that 336, that kind of area would be optimal. And the goal with these videos is to give you the tools so that you can go and do this for yourself. Not so that I can just say, do this, do that, but so that you can actually learn how to do this stuff. That's it.